Do you believe in unicorns? Of course you do. That was a silly question. Today you need to believe in unicorns to believe in the nonsense we're seeing each and every day. SPAC has become synonymous with easy money, and while certainly some good companies and investments can be associated with a SPAC, they in no way should be connected. It's simply a matter of what's happening underneath it. But nobody cares, I guess. What an absolute mess. You came here for the truth, so let me unveil that for you. Today we're going to talk about SPAC, we're going to talk about unicorns, we'll look at rainbows as well. There's a lot of information here that we need to catch up on. I mean, there's leprechauns, there's Bigfoot, there's the Yeti, there's all these kind of fascinating things in our lives and surrounding us. And sure, we need to put money into all of those because all of them are worth trillions of dollars. Now, enough nonsense, let's go. I want to break down what SPAC is for those who don't know, give you a little update, give you the data based around it because it's starting to get into the news and there's more and more investment into it. I want everybody to be aware of it. Special purpose acquisition companies, SPACs, are shell companies created with the sole intent to raise capital and buy a private organization or a stake in a company. In 2020, 248 new SPACs went public, an increase of more than 300% from 2019. 2020 was a record-breaking year for SPACs on many fronts. For instance, Bill Ackman raised $4 billion, the largest raise in SPAC history. So you know that if they get enough attention around it, if they get enough media, if the word of mouth, if this goes around in the industry, they're going to get billions, literally billions of dollars. And they create these things in order to raise capital like any other IPO, but it's a little different. SPACs are back and bigger than ever. In 2020, SPACs raised over $82 billion in capital. That's more funds in 1 year than the last 10 years combined. But what exactly is a SPAC and how have they changed over the years? Really quickly want to interject the fact that when you have a euphoria, when you have a market peak, this is generally what happens. Doesn't necessarily mean that tomorrow things are going to turn downward. Absolutely not. I didn't say that. Never have said that. But you need to understand what's happening, the euphoria, the whole mentality around what investors are doing. They're not looking for sound companies with history. They are looking for the next big thing. They are gambling, essentially. They are speculating. There's a difference between somebody who wants to put their money somewhere, they want it to grow and grow and grow, versus somebody else who is constantly trying to get to the next hot thing, and that doesn't end well. Eventually, at some point, whether your portfolio has increased by 10% or by 500%, eventually it will come down as a result of taking too many risks and not hedging your bets. No matter what you do, you always have to protect the downside. SPAC IPOs versus traditional IPOs. SPAC IPOs are essentially the opposite of traditional IPOs. A traditional IPO, an established company, goes public to raise funds. In contrast, SPACs involve a shell company that's already raised capital and is looking to purchase an organization or a stake in a company. While traditional IPOs are seeking funds, SPAC already have the funds, and they're seeking is an organization to attach themselves to. They're known as blank check companies, provide a faster way to raise funds compared to IPOs, and that's because the audit process for SPAC is shorter. They don't have any financial statements to review. Personally, I would like those financial statements to be there right away, make it all known. Like we saw with Uber, they opened up the books and my goodness, it was brutal, but investors made that decision. They wanted to go through with it, and that's fine if you want to take the risk. This is just something I think everybody should be aware of because it's getting so hot in the news today. This is the chart that's corresponding to that information out of Visual Capitalist going from 2005 up until 2020. And you could see essentially since the financial crisis, but I mean, 2020, it just rockets higher. It was getting bigger every year. But 2020, in a year where there was so many wild things happening, this is yet another one to add to the list. Real Investment Advice had a couple charts here, and then I wanted to touch on what they had to say at the end of the article. But total system leverage versus rates, you can look at the government, corporate, household, margin, banks, student loans. All of this, as shown by that orange line there, has increased dramatically over the years, and right now it has really escalated much higher. And then you see that clearly it has a complete correlation with what we're looking at in interest rates. Interest rates are rock bottom, so there's always going to be more leverage. There's always going to be more risk taking. You don't have people that save to then make sound investment choices. They go out and take the maximum risk possible, and that works so well until it doesn't. This is just a comparison of that total system leverage. Again, showing you total system leverage with the orange line, and then you could see the GDP, which is the gray line at the bottom. Let me try and pull out this highlighter right here. And it's obviously over the years. This is from 1966 up until the present day. And you can obviously note the difference. It's pretty clear. It is truly, in my opinion, not deserved, unjustified. When you look at how much debt and you say, well, debt is how they do it now. It's okay. Well, it is okay in the way that people think of it. However, that's why we get such exaggerated moves. The markets would be so much better, all financial markets, if it would be a much slower and steadier rise all throughout the process. Instead, what we have today are these huge up and down swings, and along the way, some people end up dropping off. They end up losing out big time. Instead, if it was a slow and steady rise, it would actually create more investment, less malinvestment, less risk taking. There's always going to be some risk associated with any investment, but you would have less of the swings. You'd have less problems along the way, but that's not what they're up for, right? It's all about the central bankers and what they want. Real Investment Advice always has good information to share, and I wanted to bring it to you. This is not my words. I am reading here, so take it how you want it. Portfolio positioning update with the Santa Claus rally wrapping up next week, which would be this week here that you're listening to this. We are maintaining our long bias with reduced hedges at the moment. And essentially, I'm not going to read you the whole thing, but they believe that the market is entirely overvalued. They believe that it has gone crazy, but they are keeping their money in, not selling off everything. As they say here, they are bullish in simply the fact that everybody is going in, but they are ready with their finger on the trigger, ready to pull it. They know that the market is being juiced up by low interest rates and a whole bunch of QE, and that everybody has gone long. They don't want to be in the opposite end of that trade, but they have hedges. They do have things in place, and they are understanding what's happening here, but they are taking it in a way that is very prudent. Okay? They're giving you the reasons and the responses for all of this, but just showing you that they are actually doing it wisely. They're not just saying the market will never go down. I mean, it's just ridiculous when I see that type of rhetoric. But anyway, regardless, the evidence is mounting that the economic and earnings data will likely disappoint overly optimistic projections currently. Furthermore, investors are way too confident historically. Such has always turned out to be a poor mix for a continued bull market advance in the short term. We will continue to trade accordingly, but the extreme deviations in all markets from long-term fundamentals are unsustainable. This is a problem that even the Fed can't fix. Okay, so you see their mentality here is, as I mentioned many times before, they don't like what's happening here. This is spelling out disaster, but they're still investing, but just cautiously. They are worried about what the Federal Reserve and other central banks are doing, and they are always hedging their bets. This article here is talking about what's happening in Canada, where you have some analysts that are saying the market is going to go up much, much higher 2021, and you have others saying the market could start to come down. If you look at this, it's really just what's happening in many major cities around. Okay, so don't focus on the country or the city. In a forecast this month, investment research group Veritas said that there are two possible supply shocks headed for Canada's housing market, which could flood the new market with new listings and push prices down. The first is from the tanking rental market, which has seen double-digit declines in the largest cities this year. Renters in lower income jobs were the most affected by business shutdowns, and the result has been rental markets in a free fall in many major cities. In a survey of its investor clients, Veritas found signs a growing number of investors are planning to sell. So important, if you're a person that's a landlord and you aren't making the rent enough to actually cover what you have, or maybe it's just not worth it at this point, and you think, look, next year it's not going to be like that either. I've got this capital put into this. Maybe I just sell it, take a little bit of a loss, or maybe I've made a profit throughout this period. Maybe just sell it now, cut my losses, make it happen, and then move on. That is something that we could see if this stretches on further and further. The other supply shock could come from the wrap up of mortgage deferral programs, according to Canada Mortgage and Housing Corp, okay, the CMHC. As many as 16% of Canada's mortgage borrowers got a 6-month payment holiday in 2020. The result of the program set up by the major lenders to prevent a wave of defaults, right? You remember that? Talked about that. Same situation going on in many countries, in fact. Veritas looked at all three scenarios, in which is a 5%, 10%, or 15% of houses with a mortgage in deferral were put on the market after the deferrals ended, excluding other factors. This would bring real estate prices down by 4% to 11% across Canada, including 10 to 17% decline in Vancouver and a 15 to 26% decline in Toronto. It all depends on what happens. We'll see. But certainly with this activity happening today, there is such euphoria. No, you don't have to look any further than what's going on in Toronto. That's for sure. I just wanted to bring this to you. If you want to read everything they have to say, it's quite a detailed report. Definitely check it out. Link will be in the description. This was actually an interesting article. It was talking about buyer's remorse and what people are dealing with right now, actually throughout 2020 and beyond, essentially saying that they were seeing, in one example, they're saying they're seeing their friends, they're playing this game, and so the person went out and bought this new Nintendo system, and then 15 minutes into it realized they don't even want to be playing this game, and so they stopped. The other person was buying a suit and then realizes that they don't even have a reason to wear a suit for this long period of time, and who knows when the next time will be. The other person here is talking about purchasing a home. They want it to be out in a more rural area. Then they get in, they got buyer's remorse because it needs a new septic tank, it needs new repairs, it needed this and that, structural damage and whatever it was. You get into the person at the bottom there, they're talking about they always wanted a camper, they finally got that camper, and they realized, oh well, it's not something I really wanted for different reasons they mentioned. All of these things are purchases that have been made that have really supported the economy somewhat. And I just wonder, I'm bringing this up just as a question, how much of the purchases that were made in this period were now encountering buyer's remorse? How many people were buying things that maybe they really didn't need, like that purchase of the video game thing? And how many people are doing things that maybe at this time they'll regret later on? It's just a question. I wanted to bring it to you. If you know of any examples, of course, please let me know here, and other things you believe are connected with this issue. Just a few charts from Wall Street. I wanted to show you what's happening with the US dollar share of global reserve currencies. Everybody knows the US dollar is the king around the world. You show a US dollar and you will get the credit for it, obviously, but you start to pay with Zimbabwe dollars. I don't think necessarily that they're going to accept it in many places. Of course, you can see what is happening though over the last few years. It's been slowly but surely going the way of the dodo bird. At least you can say that doesn't have the strength that it once used to. This at the beginning is 2014, and then we go into the third quarter of 2020, and it goes from 66% down to now just above 60%. And every year on average, it's going down further and further. This is a chart that brings us back to 1966, where it was, in fact, in those years of the 70s, about 85% or so of those allocated reserves. And then you can see, it changes over the years. But since 2000, that number has been slowly and steadily falling. And this presents itself with a big issue as we move below a certain threshold and you start to have others that are coming up. Now, it's a big mix. Clearly, you're looking here, reserve currencies except the USD and the euro. And there's one that has really grown, and that is the yen. Now, the yen, which was around that 3.5 to 4.0 for a few years, around that 2014, 2015 timeframe, it's been growing and growing up to approximately 6% today. Now, for much further down than what we're seeing with the US dollar, but it just shows you that things are changing. You're also seeing the RMB that has grown, but it's still a small percentage when you compare the two. I just wanted to show you that what we have here is a slow and steady trend. And this is just something that people need to keep in the back of their minds. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about selling stuff online, you want to make money, you've got to check out my free e-course. I do see comments from people that are saying that they love the course. I want to thank you for that as well. Let me know your thoughts because I rarely get any communications about it. So I'm always open. I do read all the comments. So definitely check it out, theamazongps.com. If you want to know what's going on in the financial system, you want to understand it, really, really simple. And maybe you got it down packed, maybe but maybe a friend or family member needs to wake up. These are the two books that you need to give them. Put it in their lap and say, read this, please, do me a favor. It's very easy. Anybody could read it and understand it. Check the link out in the description and you'll see it for yourself. You can actually flip through them. And last but not least, if you want the real deal, this video here is the one you got to check out. If you haven't already, click it. I'll see you there.